taxes, inflation, and the breakdown of the family are causing us to fall behind. We have the lowest net worth in the United States, and I'm sure those numbers cross the border as well.
Some people get the disability tax credit and they don't open the registered disability savings plan, and that's where the government puts in all the money of grants and bonds for a person with a disability who has done all the steps. Some people don't do all the steps.
Good morning, everybody. It's Dr. Vibe here, host and producer of the award-winning Dr. Vibe show, the home of Epic Conversations, and I'm the host of Epic Conversations, 2018 Innovation Award winner, 2020 Best Podcast News Award winner. I was getting that crazy there this week. I was mixing up, but that's a fact. And also co-host and co-producer of the only online show in the world for dads and fathers that's sponsored by Dove Men Plus Care, and being part of that team. Reached out directly and indirectly to over 400,000 dads, fathers, and male caregivers since 2020. You are listening to the Morning Vibe. As always, hope you're keeping blessed, highly favored, a magnet for miracles, and a solution for someone's problem. Ryan Knight is here on a Friday. What?
Good to see you. For those that might only tune in Fridays and have forgotten who I am, my name is one of the co-founders of the Afro-Caribbean Business Network. We support entrepreneurs of African and Caribbean heritage, really to figure out what stage their business is in and help them create a strategy to grow their companies exponentially. And I am a founder myself. I run a company called Detailing Nights. So we provide mobile waterless car cleaning. We go to people's houses or their offices, clean their cars on the spot without using water, and our plant-based, eco-friendly cleaning supplies. And shout out to my wife that's home today that allowed me to jump on early. So, hey, Shertan.
Allowed you to jump on early. Okay. All right. I'm going to leave that.
Walk the kids today.
Okay. Well, usually because it's back to school, but we'll talk about that in just a second. Let's get some house stuff going. Follow the Dr. Vibe show on YouTube and hit the notification button. Would like to get to 1,600 subscribers when you can help us, if it's up to it, but share it out. Also follow the Dr. Vibe show on Facebook, LinkedIn, and Instagram. Also, if you want to advertise your business, product, or service, on the show, or anything that's the shows I'm part of, please email me, dr.vibe at the drvibeshow.com. Also, join their Discord group where we keep it going. I got to contribute more to that. So my bad, I'm not doing more in the Discord group. I got to lead the charge on our Discord group. So that's done. And also, if you want to catch replays of a lot of the conversations, including this one, on another platform, Indie Soup Media, run by our good friend Dr. Tachi out of Fort Lauderdale, Florida. At least 17,000 YouTube subscribers in 6 months. So that's good. I'm going to run a little bit other things, some program alerts. Coming up this Monday on the Morning Vibe, Carolyn Nicole will be talking about no more picky eaters.
All right. Yeah.
Picky eaters are not just kids, adults are fussy too. So check it out on Monday. Always have great engagement and audience when Carolyn shows up because she wants us to be better, as Dr. Tachi, better. Also, live on September 10th, it's coming up, 9 p.m. Eastern.
Hasn't been canceled yet, so making progress.
Dr. Vibe and guests will be providing live commentary on the Harris-Trump debate. And I also want to do a few quick things because I spent some time. So there you go. So there you go. September 10th, 2024, 9 p.m. Eastern. Will both of them be smiling after that?
Let's talk about this for a second. Let's talk about the 3 types of life insurance, just so everybody's clear. Okay? There's permanent life insurance and there's temporary life insurance. But all life insurance is temporary. Why? Because when you transition, the life insurance term stops. Mm-hmm. So there's no forever life insurance, right? You can't have a 1,000-year policy. You can only have a policy up to the life of the person that you're with. Life insurance also, the younger you are, the less expensive it is. Mm-hmm. The youngest you can insure a human being is 15 days old. Okay. Before it shows autism, before it shows sickle cell, before it shows ADHD or autism. you insure. You insure. The
Right.
youngest you'll ever be able to insure a human being is 15 days old. This is a hack, because if you insure the child immediately, if you find out any ailments the child has 30 or 40 days after you have your checkup, policy's already approved and you're good for life.
Right.
You have a permanent policy. So let's talk about it. There's term. You can get a term policy, 8-year term, 10-year term, 20-year, 30-year, 100-year term. And this is death benefit only, no cash value. Okay? In order for you to have this policy trigger, you must die. So you will never benefit from that policy, only your next of kin, unless you're terminal. And then you can get up to 50% of that policy as a loan. And when you die, you pay back the loan and get the rest of the money. So term insurance, temporary insurance. Okay? If you're going to use term insurance, I would say if you have mortgage insurance or creditor insurance, that means the bank is asking you to pay premiums to cover them. If you should die, that your mortgage is paid off, so the bank is protecting itself, but you're paying the premium. This is mortgage insurance or creditor insurance. You pay the premium, they pay off the mortgage. Every year the mortgage goes down in value, your premium stays the same. Bless you.
Sorry. Yes.
So, imagine all these people who have mortgage insurance. I can probably get them temporary or term insurance for the duration of their mortgage at a lower cost than the creditor and mortgage insurance. Not only that, I could probably get them more insurance than they're paying for the mortgage. Because let's say you have a $500,000 mortgage and you're paying whatever you're paying per month. I can probably get you $750,000 or $800,000 for the same amount you're paying for the mortgage insurance, which will cover the mortgage and pay off all the bills and leave a legacy.
Right, right.
For the same amount. Term insurance, temporary insurance. Okay? You can have two types of temporary insurance. You can have one coverage all the way through the term. So if you have a 20-year term and it's $500,000, it's $500,000 now. It's $500,000 in 20 years. Fair? Because you're 20 years older, you're more risky. Your health has probably declined a little bit, so you're going to be more expensive. So the next 20 years are going to be more expensive. Okay?
Right.
But you can also have something called declining term. And declining term means as your mortgage goes down in value, the term policy goes down in value. Therefore, your premium is lower cost. And as you go from $500,000 to $250,000 in 20 years, half the coverage, you'll pay less in premium, but you also have less of a mortgage.
Right.
Make sense?
Makes sense.
Term insurance. All right. Again, we use term for things like mortgages because we can get a lot of insurance for a very low cost. Okay, term. Second type of insurance you have here is something called whole life. And whole life is for your whole life. You live to 105, the policy will be there. Okay, as long as you pay the premiums. And you can pay the premiums again for 10 years, 8 years, 10 years, or 20 years. Never pay another premium again and have the coverage for the rest of your life. Now, there's two buckets in the whole life policy. Bucket number one is the death benefit. So how much are you insured for? 100 grand, 200 grand, whatever you're insured for on the death benefit. But there's also something called cash value. And cash value is a cash accumulation in the insurance policy. So when you have a whole life policy, you have two buckets that are going up in value. The death benefit will go up in value every year, and the cash value will start accumulating, usually after the 5th year.
But then what ways can you use the cash? Like if that's
That's a great question, Ryan. You can use the cash. Once you get the cash to a certain amount, you can collateralize or borrow policy loan against the cash value in the policy. So once the policy, so think about this, you have a 15-day-old baby, and there's a culture that has been doing this for 100 years. They live near Bathurst, if you're from Toronto and the GTA, and they live in Crown Heights if you're from New York. And what they do is the grandparents will fully pay for the policy of the grandchild from the cash value of their policy. So it's not coming out of pocket from the grandparents. It comes from the policy. And they pay for the full policy of the child. Even if they die before the child's policy is paid off, there's a mechanism we can put in place that will pull that money out and continue paying the premiums on the policy, even if the grandparents die.
Boss move. Boss move.
Boss move. Okay? So the cash accumulation in the policy of a whole life policy, once it gets to a certain threshold, and that depends on the company that wants to give you the loan, you can borrow up to 90% of the cash value in that policy while you're alive, tax free, because all loans are tax free. So let's say you have a policy and the policy has 20, to make the math easy, we'll say $100,000 of cash value in it. You can go and get $90,000 cash money and not have to qualify for the loan because the policy is the collateral. So you don't even have to have an income.
Gotcha.
Okay? And they're going to give you $90,000. You take that $90,000, God bless you, do what you want with it. You could pay it back if you want, so you could borrow again, or because cash value accumulates every year and death benefit accumulates every year, there'll be more cash value in that policy, and you'll be able to borrow between what you already borrowed and the new level of cash value. Tax free. So whole life policy pays a dividend, and the dividend with some companies has never been below 6%, ever. World War I, World War II, Korea, Vietnam, the oil crisis of the 70s, Desert Storm, Y2K, 9/11, the financial meltdown 2008, 2009, and again in 2011, and then Corona in 2020, 21, 22. Never lost, like Floyd Mayweather. Never lost. 6% or better every year for over 100 years. And there's multiple companies who have that track record in whole life insurance. So you know it's a pretty safe bet that you're going to make money on the money. Now, there's also something in whole life policies that you can do called a paid up addition. And a paid up addition means that you're going to be paid up more life insurance. So the death benefit will increase every year as the insurance company looks at how many people are transitioning, how many people are buying, and how are our private equity investments doing. There's no market exposure with whole life insurance. S&P 500, NASDAQ, ETFs, crypto, has nothing to do with insurance. And these companies, by law, have to be capitalized to the extent that they have to have a minimum of 100% of the policy value in reserve. And some companies in Canada, right here, have reserves of 194%. Think about that.
Damn.
194% of the cash to pay out every policy to the tune of 194%. So they're not going anywhere. They're probably some of the most stable and solvent companies you could ever have access to. And if they're publicly traded, some insurance companies are publicly traded, they're going to pay a dividend to the stockholders. They have to watch the stock and so on and so forth. So the reserves are a little bit lower because they're paying dividends and so on and so forth.
Right.
Traditional dividend. But this paid up addition and the dividends you're getting in the policy have nothing to do with market exposure. This is the company saying, we made this much in profit sharing. We're going to give you a dividend on that. And they've never lost in 100 years. It's one of the safest bets you can make in investments, but people don't know about it. Okay.
Is the dividend that it pays out different than the cash value that you can extract?
The dividend will add to the cash value.
Oh, okay. Gotcha.
So the dividend, great question. The dividend will add to the cash value. So they're going to give you a basic cash value every year, plus they're going to give you a dividend of at least 6% that has never lost in 100 years. The dividend is not guaranteed, but the dividend has never failed to pay.
Gotcha.
Okay. So that's whole life insurance. You have no transparency to what they're investing in, how they're investing, where they're investing. You have no idea. Just know you're going to get 6% dividend every year and paid up additions. Okay.
Nice.
I'll let the chat catch up.
Go ahead. You've been dropping some knowledge on. So Heather says, educate your children and or your beneficiaries.
Right.
She also says, Wayne has always been a boss with money, even at 7 years old. Drea Rich says, good morning, gentlemen. She goes, had to borrow money from him to buy pizza.
Okay.
And I cried. I gave her, she go, Wayne, you have any ones? Yes, they gave me a $5 bill, and I gave her 5 ones, and I was vexed because it was less paper.
Also, Minion Cam says Gerber is selling life insurance. Drea Rich says, to answer Wayne's question, I have a will but no personal life insurance or work plan. Many on campus, it's possible to have insurance coverage after disability. There are rules on pre-existing conditions, but you have to cover any future diagnosis in some insurance plans. I spent last year researching. Heather says our mother had mortgage insurance as well.
Gotcha.
And Minnie on Cam says some credit cards are selling creditor insurance in your credit card.
Yes, and all those things I would avoid. I would say do not buy insurance from credit card companies. It's kind of like buying a roti from a Jamaican restaurant. It probably is okay. But if you want real roti, you got to go to a Guyanese or a Trinidadian restaurant. It just kind of makes sense. No shade on the Jamaican restaurants. You want oxtail, you go to a Jamaican restaurant. But if you want roti, come on. So I would not recommend that you buy insurance company from Gerber, the food company, or buy it from a credit card company in any shape or form. You buy insurance from an insurance company. There's enough of them in Canada for you to get a fair price and a real product that will do its job when you can't.
Okay, I got a second line of comments here to go through. Sean says lots of great 411. There you go. Drea Rich says, what is the benefit of life insurance when no one has dependents or spouse? Are there different considerations for a will for a single person?
Just before you finish that, my apologies. I do have to run to this event.
Yes.
I'll hop off and I'll let you answer.
No problem.
Thank you much, Wayne.
All right. Take care.
Have a great weekend, Ryan. Thanks for coming.
No problem. So do you want to answer that question, Ray?
Yeah, 100%.
Yeah.
When you have no dependents, Drea, you're either going to leave a legacy of wealth or you'll leave a legacy of debt for your next of kin. That means your brothers and sisters and your parents, they're going to be responsible for your debt. So rather than you leaving them with a debt that they have to pay because they're next of kin, you go get yourself enough to cover your final costs, and not just your final costs for arrangements, whether you want to be buried or cremated, but also your final estate taxes, which is what most people forget about. You in this country and in the United States, when you die, you have to pay estate taxes. And depending on what you have in assets, you have a bunch of stuff in your 401k, you have a Roth IRA, you got a bunch of different things going on. All those things become deemed as sold, and you have to pay the unrealized capital gain when you pass. That's not on you, that's on your next of kin, and they will find them. So rather than leaving them that debt, make sure you have enough life insurance to cover your final arrangements, however you want to be arranged, as well as your estate taxes and any probate you may have to pay depending on your income. Okay. Now, if you don't have any money to pay for life insurance, depending on where you live, the state might cover you. I know in Ontario and in Quebec, they'll cover up to $2,500 if you don't have any means of doing it yourself. And they're just going to cremate you and take the ashes and throw them away if there's no one who's going to come and claim them. So if that's the way you want to go out, then that's an option. But I would strongly recommend for a very nominal price, depending on where you live. If you're in the geography of British Columbia, Alberta, Manitoba, Ontario, Quebec, or New Brunswick, I got you. If you're in the state of Maryland, the DMV area, I've got people down there, and in other states in the United States, I will take care of you. Happy to show you what's possible at a reasonable price. But this is why you want to do it. You don't want to leave people with a legacy of debt. You want to leave them, if you don't want to leave them wealthy, you want to leave them at least neutral.
Exactly. And I was putting up on the screen, it's in the comments on most of the platforms that you're watching this live in the replay. There's Wayne's contact information, book an appointment with him, email address, and Instagram. There are a few more comments before we get back to things. Let me just, there's so much. Oh, Drew says, hit enter too quickly. Meant to say that these discussions in general, not Wayne specifically, do not always consider a single status.
100%. I mean, single people have the ability to transfer their wealth to their alma mater. Maybe they want to leave money to, Howard University if they went to Howard University. Maybe they want to leave it to the local political party. Maybe they want to leave it to the local shelter. You don't have to have dependents. You can do good for the community and help a bunch of kids go to school with that money. right? Help provide for backpacks and school supplies for the local elementary school because you know it's underserved because the tax base is not strong enough to make the school better. You can do a lot of things with that money to leave a legacy as opposed to just worrying about having dependents or having a spouse. So lots of things you can do. Create an endowment, maybe in your mother or grandmother's name or grandfather's name, and say, listen, this is going to be the so-and-so scholarship, and you're going to give out $1,000 to 5 kids forever because they'll never eat the endowment seed. If you leave $100,000, whatever that $100,000 kicks off, and like I said, the dividend can pay up to 6%. It's going to kick off $6,000 a year, meaning that you're going to have 6 scholarships of $1,000 each to give to students forever because we'll never touch 100,000.
Good stuff. So Minnie says, Drea Reese, is possible to invest your life insurance with segregated funds. I have no children and not married and have my life insurance products. Also says, my RSP, TFSA, and FHSA are segregated funds only sold by a company under Life Insurance Act. Fitness IQ Cam says, cover off any debt you have with a life insurance policy. You wouldn't want your loved ones to pay it off while they're grieving.
Facts.
Minnie says, I speak on the single and disabled last night. You did. And Fitness IQ says, and cover funeral expense if you didn't pre-plan that.
Right.
Minnie says, insurance can be the wild, wild west since so many companies are selling insurance, but it's not their primary industry. Fitness IQ says, actually had my creditor insurance and it was actually beneficial. Okay. Minnie says there's a book for Canada's Canadian's Guide to Personal Finance for Singles. Okay, you know what? I'm going to hold it there and let you continue, sir.
Okay, so that's whole life insurance, right? So again, for your whole life, you have no visibility to the investment, but you have 2 investments. You get paid up additions, which means the insurance company is buying you more life insurance. So it's basically an inflation protector for you. And then you have the dividends for participating whole life policy. The dividends will meet the cash value. When you look at what you will have in dividends, should you go deep into life, and many of our women do, in the 90s, late 80s and early 90s, it could be millions of dollars, and you can stop paying the premiums after 10 or 20 years, but you'll have millions of dollars in your 80s and 90s. That means you can use the cash value in the policy to give inheritances while you're alive. You can give money to your grandchildren to help them buy a house. You can give money to your daughter to help her get a better or new car. You can go and travel everyone, all 3 generations, and go to Africa with the cash value of the policy while you're alive and in good health. Go to Machu Picchu while you can still climb the steps, rather than waiting for you to transition and then have them spend the money any way they want. The other thing you can do with a whole life policy, you can also do it with a universal life, which I'll talk about in a second. You can meter what goes to the beneficiary. So rather than giving someone who might be considered a knucklehead in your family $1 million and having them go out and buy pizza Mustangs, you can give them $2,000 a month and have the insurance agent and financial advisor give them that money on a monthly basis on the drip, and then they will determine if this person is ready enough, mature enough to receive lump sums. Otherwise, they'll continue getting $2,000-$3,000 a month for the rest of their life. So they're not left out of the will. They're just not getting the lump sum. You can say this person gets a lump sum because they're grown. This person gets $2,000 a month because they're not ready yet. And then they can transition. We come in and have a checkup for the neck up, see if they're okay, and then it's okay. I believe you have shown me enough that I will give you the lump sum. I don't have to give them all of it. I can give them half of it and see how they do. And if they do well with it, that's okay. I'll give you the rest. But you take judgment out of their hands if they're immature. Okay? And you can have like basically a trustee for them to meter the cash. So that's whole life insurance. It's for your whole life. It can be expensive depending on age and depending on pre-existing conditions. But if you were to get this policy for a 15-day-old baby, it's the least expensive it will ever be. And is a gift that will guarantee 3 generations of wealth tax-free. Okay? Before I move on to the other 2 types of life insurance, I want to tell a story about the Rockefellers and the Vanderbilts, 2 families that everybody should know about, especially if you're in the United States. The Rockefellers had a Rockefeller Family Trust, which owned the life insurance policy on every Rockefeller born. The insured was the Rockefeller who was born, and the beneficiary was the trust. So while those Rockefellers were alive, they would borrow against the cash value of the policy. So when people say tax the rich, you're assuming the rich have income, W-2 or T4. They don't. They're borrowing against the cash value of their insurance, which is tax-free. They live their best life, buy boats, buy cars, buy buildings, travel the world. And when they die, the trust pays back what they borrowed, keeps the difference and the death benefit for the next generation. The Rockefellers have been doing this for over 120 years. The Vanderbilts did not. The Vanderbilts kept their policies in the name of the Vanderbilt that had it as the owner. The Vanderbilt was the insured, and the beneficiary were the Vanderbilts who were left over. And what they did was they ate their seed. And because they ate their seed, the Rockefellers have billions of dollars in their trust, and the Vanderbilts don't. That's why Gloria Vanderbilt's son works on CNN, because they spent their seed over the last 100 years. Okay, Vanderbilt University, all this good stuff, and Gloria Vanderbilt, venerable brand, and now there's CNN. Now he might make a couple $1 million. He's not broke, but he's not a billionaire, and he should be. That's a lot of compounding over 100 years that he should have had. Back to the comments, Dr. Mike.
No problem. And for people who don't know who her son is, a gentleman named Anderson Cooper. Just want to, they may not know. So Drea says, let me go to this comment. Tim says, to me, I can thank you for the feedback as well. I have some investments as well, just not a life insurance vehicle. Also says, thank you for that response, Wayne. I am in Toronto. I have an RSP TFSA well enough to bury me. That is why I figured no life was necessary. I figured I would leave my home to my sis to sell.
Right. So if you have the RSP and TFSA in a bank or an investment firm, and they're over $50,000, and you're in Ontario, which you said, you will pay probate. 1.5% of your estate will go to probate just for the pleasure of dying in Ontario. And then the rest of it will go to the estate. And if you don't have a will, living will, and power of attorney, the government will provide one for you, and that will take money from the estate, and that will take twice as long for it to settle before your sister has the ability to sell. But while she's waiting for that, she can't get access to the money. Wow. Because she's waiting. Now, if you have a named beneficiary on the TFSA and the RSP, she will get the money and it will bypass probate, but it still has to go through estate tax. Or would you prefer her to get the money tax-free? So that's the question you have to ask yourself. If she's going to be selling the house, it would be nice for her to get the money in less than 30 days from me, rather than waiting a year plus for the government to settle the estate. Okay. And there's a way to do that.
Yeah. Minion Cam says, being eligible for ODSP, I found out my burial costs is covered.
Nice.
Let me get to this. She says, to Drea Rich, personal finance is personal. When you know the basic concepts, you can once you know the basic concepts, you can decide your life long term. All right, continue, Wayne.
Okay, so that's whole life. Next, to compete with whole life, but to be a little less expensive, was a policy that you could have for the rest of your life, where the premium would stay the same, just like whole life insurance. The premium stays the same; it never changes on you, and it's good for you to live past 100. This is universal life. Now, universal life, you can also get cash value, but the cash value in the universal life is totally under your control. Once you pay the cost of the insurance, anything above the cost of insurance is the investable portion of the universal life. In a whole life policy, you don't know what the cost of insurance is, and you don't know what the investment portion is. All you know is you get a dividend and paid up additions. That's all you know. It's kind of like Ronco, set it and forget it. No visibility to what they're doing, but they're going to give you 6%. Okay? Universal life, you can control the investment. You want to put it in the S&P 500, you can do so. You want to put it in the NASDAQ, you can do so. You want to put it in some certain segregated funds that will allow you to look at your risk tolerance from very, very conservative all the way to 100% equities, you can do so. But you ride or die by your knowledge. and the knowledge of your advisor. So I will do a risk assessment, a risk tolerance for you, see where you're at with risk tolerance, and then I will choose investments with you at that level of tolerance and let it run. If it returns more than 6%, you beat the whole life and you're paying less premium to do the exact same thing the whole life is doing. But I have some of my nurses are making 18 and 19 and 20% on their universal life policies, which is tripling what they would get in the whole life policy, and their premiums are lower. Not every year are good years, but even when we have bad years, because it's managed portfolios, the bad years aren't as bad as if you were doing it yourself, and the good years aren't as good as you're doing it yourself. You smooth it out a little bit by having the portfolio. So universal life has the ability to borrow against a cash value, but you can't borrow 90%, you can borrow 80%. And when you borrow from a universal life policy, some of the lenders will want you to move your investment from where it is balls to the wall and move it to something more conservative so they can guarantee they can get their money back from you. So they're forcing you to control that portion that you borrowed. Needs to be in a very low volatile investment. Fantastic product, much younger than whole life, only been around a couple of decades, but if managed properly, can work just like a whole life policy, because what you can have is a level cost of insurance. That means the gap between the cost of insurance and the amount that you're contributing, that amount is investable, and that gap will never change. This is called level cost of insurance. If you want to get the benefits of being younger, you do something called YRT, which is yearly renewable term, which means every year you get older, your cost of insurance goes up. But because the gap between where you're investing and the cost of insurance is so wide, as you get to a certain age and stage, you can never have the policy lapse. This is why it needs to be designed by somebody who knows what they're doing to ensure that even if you get older, the cost of insurance will never surpass the premium, therefore the policy will never lapse. Plus, you have all those years of compounding tax-free in the policy. And because we're borrowing from the policy, not taking the money out of the policy, because if we take the money out of the policy, it becomes income. And what's the second word after income in this country, Dr. Vibe?
Tax.
Tax. So we never take the money out of the policy unless we absolutely have to. We borrow against it, because even if we're paying for the loan, if we use the money to do an investment, the interest on the loan to borrow is tax deductible. So think about that.
Yep.
I'm going to borrow from my policy that's paying 6%, take that money and buy an investment that's going to pay 12%, like a second mortgage on a house, or 14%, keep the difference, pay back the 6%, but because I use it for an investment, the 6% that I'm paying on the loan interest is tax deductible. It just gets better and better if you know what you're doing.
Exactly. Exactly. If you're willing to ask, you know. Drea Rich says, oh, yes, my funds are in an investment firm. The amount is over 50K. Thank you for those details about probate. I definitely do not want my sis to have issues. I may consider reaching out to you.
Appreciate that, Drea. Hey, listen, my financial needs analysis is complimentary. So you reach out to me, and you don't like my bald head, or you say my Bajan accent is too much for you to handle and you want to work with somebody else, you still have the document. You can go somewhere else. But I would hope you give me a chance to show you what's possible with your personal situation, keeping everything in confidence, obviously, and showing you a way to put your sister in a much better position. Okay?
Good stuff.
So universal life, permanent policy, premium never changes. Cost of insurance can increase every year, giving you the ability to make more money early, so the compounding works in your favor. Or if you're over 45, you do a level cost, so the gap between the cost of insurance and the premium will never meet each other, so there's no risk. So the policy runs today, the policy will run forever, and you can pay it off in 8 years, 10 years, 20 years, or however you want to pay it off. We can pick a date. So when you say I'm 65, I don't want to pay any premiums anymore, no problem. We can have the date at 65, so you can stop paying the premiums, but the policy will be there for the rest of your life.
All right.
Okay.
Drea Rich says, I'm okay working with bald heads.
Let's go. All right. Let's go. All right. So that's universal life. And universal life became very popular because it gave you the same benefits almost as whole life at a lower cost, especially for people who are finding out about it in their 30s and 40s and 50s. Okay, so it's something that I offer, but once I do my analysis, I'll know which one makes the most sense, and I'll give you all options. I'll show you what whole life looks like, I'll show you what universal looks like, and I'll show you what our next type of insurance is: term insurance. And term insurance or temporary insurance is just that. It's insurance you can buy for 8 years, 10 years, or 20 years, or up to age 100, term 100. There's no cash value with a term policy. You cannot benefit from a term policy while you're alive in Canada. You may in the United States, but I will not speak on that since I'm not licensed down there. Term policies are just that. If you don't die, you don't get paid. 84% of term policies do not pay out. What do you think that is, Dr. Vibe?
Maybe I'm overthink. I overthink. It's probably a very simple answer, but I'm not thinking it off the top of my bald head.
Nice. 84% of term policies don't pay out because you didn't die.
I was gonna say that sounds too.
Always go with your first thought, Dr. Vibe.
That's true. That's true. Yes.
Like multiple choice.
Yeah.
All right. So you didn't die. So the insurance company did its job, but you didn't do yours. You didn't die. So now they're saying, well, now the price is going to go up. So if you get a term 10 policy, which is one of the cheapest policies you can get because the term is the shortest, the risk is the lowest in the insurance company. So they give you a great price. $10, $9, $12 a month for like $100,000, $200,000 of insurance. You're like, this is amazing. I'll do it. Great. But when the 10-year comes, you have guaranteed convertibility and guaranteed renewability. What does that mean? It means if you are with the right company that offers whole life and universal life, you can convert your term policy to a universal or whole life policy at the age you are when you do the conversion. So it'll be more expensive because it's a more expensive policy, but you're also older. But once you get to that crossover, that premium is the same for the rest of your life. Whereas term, every 10 years is going to go up, and it's going to go up significantly, 7, 8, 9 times what you're paying. So
wow.
some people are paying $15, $20 for term life, and then when they have to renew, it's $80 a month, and then they have to renew, it's $300 a month. They have to renew, it's $800 a month.
Ouch.
Okay, so people need to understand what the triggers are on their term insurance. They will allow you to renew. We have a situation here with a client. They had a term policy. They had a term 10, and they were in their 70s, and they found out that they were terminal, and the policy was going to jump in premium price. But they had $1 million in term insurance, right, for 10 years, 70 to 80. But at 72, they were deemed terminal. So just before it was going to increase, they were deemed terminal. So they had a choice: continue paying the $150 in term, or pay the new price, which was $1,400 a month for the same insurance, because they were so old and so risky.
Oh.
And they came to me and said, what do we do? Do we cancel the policy? $1,400 is too much. I said, no, $1,400 is not too much. Because your father has 2 months to live. So you're going to pay $2,800 to get $1 million back. I go, fair deal. They go, fair deal. I said, go pay the $1,400. Now he lived 4 months. So it's $5,600 they spent on the insurance.
But still.
But $5,600 for $1 million back? This is why when people say, oh, Wayne, the robo-advisors are going to compete with you and cut your grass and take you out. The robo-advisor would have said the premium is going up to $1,400. What do you want to do? But the live advisor is going to tell you, hey, they said he's terminal. I hope he lives as long as possible. But you should pay that. Go find it wherever you can find it and pay this premium. Because when he passes, you have $1 million, and you can go pay back whatever payday loan you needed to get that $1,400 a month. Okay? Every situation is different. So term insurance is fantastic to replace creditor insurance and mortgage insurance. The cost per $1,000 of insurance is much less with a personal policy versus a bank underwritten policy. So term insurance is where I use it. Also, for people who are just getting into insurance and don't have a lot of cash flow at the end of the month, term insurance gets you into life insurance at a very, very fair and reasonable price. And once your life situation changes as we start working together and you start understanding your relationship with money, then we can convert it to a permanent policy down the road when you're more economically stable. But for people who are economically unstable, term insurance is a good option. And term, again, is a way to get a lot of insurance for a very low price. Here's the problem with term. If you miss a payment, policy is canceled because there's no cash value to prop you up. I had a young lady, I was talking to her yesterday. She pays her policy quarterly. She goes, wait, I don't see the money coming out of my bank account. And her premium is about $340 a month. She goes, I don't see the money coming out of my bank account. What's going on? I called the company. She missed a payment in February 2022. Okay. And because she had cash value, because the cost of insurance was $102, but she was contributing $340 a month. Why? Because the difference between 102 and 340 is her investment, right? Her cash value. So when she missed the payment in February, the policy of the company is we don't want to lose a customer. We're going to use the cash value in the policy to pay the premium. And they've been paying the premium for the cash value in their policy from February 22 until we called yesterday because she couldn't understand why the money wasn't coming out of her bank account. But they weren't paying the 340. They were only paying the cost of insurance because that's all they're worried about is the 102. So she's been paying 102 every quarter for the last 2 years. No money coming out of her bank account. She goes, man, I was wondering how come I wasn't paying this premium. And she didn't call. She was supposed to call me. I said, call the company. And she wouldn't call the company. I finally got on the phone with her, did a 3-way call. She found out the company was saying, yeah, well, we'll protect our policy and protect you.
Yeah.
Right. At the cost of insurance. Now, the difference between the 102 and the 340, that's on you. She goes, I can handle the 102 this quarter. I can't handle the 340, but 102 I can handle. So she's going to pay 102 herself and stop diminishing her cash value. Now it will start to accumulate again. Okay. Just an example of someone who had the policy for a significant amount of money because she has like a 7-year-old son and a mortgage, and he would have almost $1 million going to his trustee, pay off the house, and still have money left over to pay for his university if something were to happen to her.
Wow.
Right? So if she wants to, she can say, listen, he can sell the house because the house has gone up in value since she got the policy. I can reduce my amount of insurance, right? So I reduce the amount of spend I have because I don't want him to pay off the mortgage anymore. I just want him to sell the house. But because the house is worth so much, there's going to be a very large capital gain. She says, I'm happy to have him have the capital gain rather than me paying the premiums for the insurance. And you can make those decisions.
Wow.
So to recap, whole life insurance, forever insurance, you don't know what the investment portion is, but there's a cash value portion and a death benefit. Never has the dividend gone below 6%, and never have Canadian companies not paid out the death benefit. The only time they don't is fraud. You tell them you're 35 and you're really 38. You tell them you're a female and you're really a man, right? You tell them you're a non-smoker and you're a smoker. Fraud, right? Then it doesn't pay 3% of the time, 97% for most companies. Whole life. Universal life. Just like a whole life insurance, one premium forever, insurance until you transition, one premium, one price, but you have 2 buckets, cash value and death benefit, but you can control the cash value. You can put it into very aggressive or very conservative investments to meet the same level of risk as the whole life, but at a much lower cost of premium per month. Universal life. Third, term insurance, to be used for mortgages, to be used to get a lot of insurance at a very low price. No cash value. The premium will increase at the end of the term significantly. So you have to be careful of companies that say buy term and invest the rest, because they're going to say buy term and invest the rest, and you're going to buy term and spend the rest. And then when the jump comes, and I do a lot of reviews of other companies' insurance. I said, do you see this premium here? She goes, yeah, it's stable for 30 years. And then you see it go up every year from year 31 all the way to year 95. They call it term 95, and that's fine. But as long as you understand that the premium is going to go up. So what they say to you is you should cancel the policy because by then your TFSAs and RSPs are big enough to cover you and yourself insured. That's a philosophy for a lot of people, including some famous guys who talk about budgeting and debt in the United States. But you have to know what's right for you. Okay,
100%.
a lot of these pundits have rich parents.
Okay,
Back to you, Dr. Greg.
no problem. So Minion Cam says the importance of knowing what you have and paying bills on time based on the situation you just shared with us. Says when the mortgage is paid off, you have more money to work on for your investments. Fitness IQ Cam says, ooh, you just made me think of something. What about non-binary or transgenders individuals? How are they accommodated?
What was your gender at birth? Is how they answer that question.
Okay.
And that's how you're rated by the company, your gender at birth.
Okay, good stuff. And Minaka says, can many forms, including on the application? I wonder how insurance payouts are adjusted for that. Okay, so I think you answered that question.
Yep.
And of course, he's here in the background. Good morning, gentlemen. Great segment, Wayne. You hit it out of the ballpark with this one. Lived experience plays a significant role in how we navigate life.
Thank you to the Godfather, Ray.
Yes, the Godfather is in the house.
I can't stress enough. Do not have your estate be the beneficiary, because you take money that's tax-free and put it back into harm's way by putting in the estate, which is taxable. So named beneficiary. And all of you who are single, married, divorced, make sure you update your named beneficiary, because it could be your ex-husband. Him and his new girlfriend will get that money because you didn't update your beneficiary. And the person you're living with will see that money go directly to them because it's not a part of the will. It's separate from the will. So insurance is separate from the will. So make sure you look at all your insurance policies and make sure you update those beneficiaries, because somebody gonna get hurt real bad if you don't.
How, as we start to wind it down here, how often should individuals or companies review and update their life insurance policies?
I do annual or semi-annual client reviews.
Okay.
So I'll sit down with you and say, has anything changed? Oh, the company's doing really, really well. We want to increase our insurance because everybody's end is bigger because we're making more money consistently. Also for families as well. I was in Vaughan. They are pregnant. They're about to have a baby. They didn't have any life insurance on either parent personally. The husband had it on himself through work, which was 2 times his annual income, which is not enough to raise a child to 18. But with what I gave them at a very reasonable price, they both have insurance now. And if anything happens to him or her, they can either one can raise a child to 18 and pay for school.
Right. 2 last conversation. Well, I could go on forever, but I'll just go with 2 last ones. What are common misconceptions about life insurance that you'd like to talk about? If any, I know you may have covered, but any other ones you want to chat about today?
Everybody needs life insurance. If you're single and have no dependents, give money to a good cause. Make sure whomever you're leaving with the bag has enough money to pay the taxes on the bag. So if you have no spouse, you have no siblings, you have no one you want to give it to, there's got to be a cause that you can give to that will help them live to see another day. It could be a homeless shelter in your neighborhood. It could be an elementary school. It could be a church. So I think everyone should have life insurance of some sort to make sure that whoever they are leaving behind does not have an economic burden because they transitioned.
And final one, I'm going to ask you, how can technology impact the future of life insurance products and services?
Technology already has. There are a number of robo-advisors who will ask you a series of questions, and depending on which rabbit hole you go down, we'll come back with answers. I'm not saying that the computer is going to be wrong. I'm just going to say the computer has speed and simplicity. That's king. But context is queen, and I have the context because I can ask questions that are not a part of the algorithm. I can say, so you're Jamaican, right? Okay. And your father had insurance, right? And it went well for him, right? Good. So you see how that helps you. So and so on and so forth. So I can drill down beyond what the algorithm has, and most of those algorithms do not have the contextual nature of the Black experience in Canada or the United States, let's just say. Most of the people who are asking those questions are asking them from a position and a demographic that may not reflect the audience of the Dr. Vibe show, or a lot of my clientele, although I have clients across the rainbow, all modalities, all genders, all races and cultures.
Yeah, I think just my lens on this, when you're dealing with your life and your future, I don't want an algorithm. That's just me.
Yeah, you're
Right.
at the age and the stage where that makes sense.
Well, and regardless, I think that when you're dealing with your existence and you're serious about your existence, you need someone that you can have a relationship with. If you can have a relationship with an algorithm, go for it. But just me, when I'm talking about my life and how I move through the world, especially in this area, algorithm ain't gonna cut it for me. That's just me. That's just me. That's just me. All right. As we close out, Beyond Cam says death, disease, and divorce. Death, disease, divorce, and disinterest. Things you need to think about when in a business with a partner. She says ODSB has to review all loans to see if they fit policy descriptions, section 5.10. Loans, it does not matter if you have a corporation. And then with ODSP, if the financial decision is not approved by the caseworker, it can cause consequences with ODSP benefit unit member eligibility for the Ontario Disability Support Program. And then Dr. Tati says, finally, she says, this was great information. I could have went deeper in about the business thing, but I said, hey, time factor, and we all have things to get to. Wayne, as always, thank you so much for taking time out of your positive, productive day. Thank you as always. Yeah, I'm telling you, you're upping our game, because you saw Ryan and I both came on with shirts, like dress shirts today. So yeah, the Wayne Uncle Ray effect is moving. It's moving along. As always, if you want to touch base with me, and I've again put in the comments section on most of the platforms that's watching this live or replay, there is Calendly, email, and Instagram. Let me just see and Drea Ritz says this discussion was very helpful. Thank you, Dr. Vibe Wayne. Drea, I'd love you to reach out to Wayne. Can I get a little, even, it's complimentary. I would love you to reach out to Wayne. That would make me a very happy person. I'm not saying, I'm just saying. Mr. Harris, as always, thank you for taking the time. All the best, you and family, and we'll see you next one. But I think I want to get back, have another go a little bit deeper about the whole business and life insurance.
Sure.
We just skirted the top of it, but I think enough, and we have a lot of business people that watch this. I don't think they have enough, and I'm just thinking they need to a little bit more to know how they can take advantage, because if we're not taking advantage individually, probably not taking advantage at corporate wise.
Agreed. All right. Thank you very much for the opportunity and the platform, Dr. Vibe. For everybody here, follow me on IG at Wayne Harris World and book me.
Yes.
1 hour. We're going to know whether you are winning or losing. And once you have that information, you can make a decision for yourself who you want to work with. But I'm happy to work with anybody who wants to work with me, because trust me, there are secrets and we should know them. And last I checked, no one's telling us.
Well, that's the thing too. And especially if you're watching North America, within the next year and a half, there are going to be elections, right? So you want to be prepared for the shifts that are always coming, but there are definitely big shifts coming in both Canada and the United States. So preparation. And let's see any more comments here. Look at this. You're always a great. No, I just manage the ship. Your bro takes care of the ship when I'm on, Heather. She also says, great show learning as always. Rhea says, I am definitely considering Dr. Vibe. I have another friend that does life insurance, so I just have to give him a chance. But Wayne is great. No problem. But you know what? Experiment. The more you know, the more you need to know. Just a thought. You have with more.
Give a second opinion.
And also with more, as I learned, someone said, with more options, there's more freedom.
Agreed.
Take care, my brother. Be well and keep the faith. Peace.
Have a great weekend, Dr. Vibe. Bye.
All right, family. Amazing conversation. And you know why? Wayne showed up. You showed up. That's what me. I just steered the ship. Drea says, you're right. And I do like Wayne's knowledge. I just make suggestions. I don't tell people what to do, because telling people to do what to do got me this. And I don't mind my shiny head, but I always think, how did I get it? By trying to tell people what to do. That's how those things happen. So let's close it up today, as always. So let's close up with some things. Please subscribe to the Dr. Vibe Show on YouTube. Hit the notification button. If you're up to it, please subscribe. And also tell people about it. Share it out. Like the Dr. Vibe Show on Facebook, LinkedIn, and Instagram. As always, if you want to advertise your business, product, or service on their show or any of the shows I'm a part of, email me, dr.vibe at the drvibeshow.com. Join the Morning Vibe Discord group. I'm going to put the replay of today's conversation definitely in the Discord group. Again, coming up on this Monday's show, Carolyn Nicole, certified holistic nutritionist, will be talking about no more picky eaters. Yes, kids are gone back to school. Not only can some kids be picky eaters, but so adults can be too. And then also this Tuesday, September 10th, 2024, 9 p.m. Eastern, I'll be hosting guests from 4 African American queens and 3 African Canadian kings will be giving live takes on the scheduled Trump, I said that, 45 Harris debate. All right, so let's check it out. This is how you can get a hold of Ryan. Website, LinkedIn, Instagram, and email. And for myself, website, YouTube, Facebook, Instagram, X/Twitter, and email. And you can watch replays of this epic conversation on the Dr. Vibe Show. YouTube, Facebook, and LinkedIn, Afro-Caribbean Business Network on Facebook and YouTube, and Ryan Oneil Knight YouTube. So this is how we close it off. Live your life as a dream. If you can dream it, you can make it. Sometimes you have to get small to get stronger. Block assumptions. Then aim bigger, aim better, aim higher, aim wider. Love, faith, and respect. And remember, just don't manage your time, manage your energy, and remember to give yourselves grace. Have an excellent weekend. Oh, got to tell you too, tomorrow night, if you're watching, Primetime Saturday with Aisha and Lala, where they'll be giving their takes pre-debate and all the stuff that's going on in America. And then Sunday afternoon, Cesar Nadima Musa, Black Canada Talking. So if you want to get a warm-up of all the people who are going to be showing up on Tuesday, actually, almost all of them you'll see today till the end of the weekend. So God bless. Peace, well, keep the faith, walk good, and we'll chat with you soon.